With the Fed promising a series of interest rate hikes, many are wondering if it's time to take defensive action in their portfolios. Christine Benz with the Morningstar Financial website suggests those on the cusp of retirement taking stock gains and moving that money into more conservative investments like cash and bonds.
If you haven't gone through that de-risking process and you're getting close to retirement or you're already retired, I don't think it's too late to do so. On the other hand, if you just rebalanced your portfolio at the end of 2021, you're probably just fine. You probably don't need to make any further changes to prepare yourself for rising interest rates.
Brian Bowen, what do you think of her advice?
I just love that generalized advice that just applies to everybody.
Yeah,
right?
yeah.
So general.
Yeah.
Like, oh, well, yeah, that's exactly what I need to do. Let me go adjust my portfolio because Christine Benz sends that.
That's how the palm readers do.
I know. I mean,
is there a male in your past?
Yeah. Right. So I think, depending on how much risk you're willing to accept, there is so much technology. When I started 20 years ago in the industry, we just didn't have these tools. They weren't as effective. I don't think they had done enough scientific research. And we also hadn't gone through two huge market collapses, right?
Yeah.
The dot-com bubble, the 2008 recession, the housing crisis, and of course, even COVID now, the third one. I wouldn't call it necessarily recession, but it was a correction,
It was
right?
kind of a recession.
Yeah, I mean, it was so anyways, the point is that, Christine's saying here, you really should take a look at your risk. Yeah, I agree with that 100%. You need to take a risk. And when people, for the first time, they do, come in and we give them a second opinion, the second opinion service that we talk about a lot, right? They come in and they give us their statements. Here's my 401k. Here's my brokerage account at Charles Schwab. I have an account at Fidelity, right? And we take every single position that you own and actually enter it in manually. It's a lot of manual labor.
Oh, man.
It is. And when you do that, though, the software is able to tell us, hey, on a score of 1 to 10, 10 is you're high risk. You should be in Bitcoin, right? 1, you should be at the bank and CDs, and or you're a 5, right? And based on your answers, like, I'm not really willing to lose money. Well, you're probably a 1, right? If you literally do not want to lose a cent and you are okay with a 1% gain, then you probably should,
Yeah, CDs, pennies.
Yeah,
That's what you go
CDs
with,
are
yeah.
fixed products, right? Something that has a guarantee that you're not going to lose money. There are investment products that are, I couldn't even call them investment, or they're savings vehicles, right? But the point is, somebody that's a 7 is going to be very uncomfortable with investments that are a 1 or 2 because they're going to be like, hey, I'm not getting any return. What's going on here? And so I think that's the issue is you go through this questionnaire and it takes a few minutes. I don't know, maybe it's 5 minutes. It's not that long. Once you go through it, then I'm telling you, you can really dial in and make sure that you're a 7. Invest like a 7. 90% of the time, people are actually taking more risk than what they're saying they're willing to take.
That's what I was going to say. How many people actually were wrong in what they think their assessment is?
It's very rare that it's most of the time they're wrong. And they're taking too much.
But wrong by 1 or 2 points,
No,
or like
I mean,
one from like
no.
a 7 to a 3.
No, I would say it's not that drastic. I think that's probably on the minority. It might be 20% of the time that it's a real drastic.
Yeah.
But there's still a difference. They're investing on an 8, 8.5. And most of the times it's DIY investors, not people that have advisors. Advisors usually have gone through something like this before. And
Yeah.
they're kind of moderate, and so they've got them in a moderate portfolio. But here's the thing, you're gonna make more money if you stay invested appropriate to your risk, because this recent correction, we didn't have people calling and panicking and going, "Get me out of the market," because the risk that they were in was appropriate for them, right? And the portfolio took
Meaning you've got them on the right track.
right.
Yeah.
We have them dialed in, so they weren't calling and panicking. Actually, we did have. I think I told you this on the radio before. It was a few weeks ago. We had one client that did call in, couldn't get in his Fidelity account, and he's like, "Brian, I went out of the market completely. Get out of the market." It was the day that the S&P and the Nasdaq was going down 3 or 4%.
Yeah.
I have to go back and look what day that was. But I go, I'm pretty sure your account's already sitting in cash, and the little bit of money that actually is in the market, per se, in quotation marks, is short-term bonds.
Yeah.
So
you're safe.
I'm pretty sure you're
all right.
safe. But let me go check your account real quick. I pulled it up. And I looked and I said, yeah, it's not even moving today. Like you're down 0.01%. I mean, it didn't go anywhere. And so he's like, okay. All right. I'm just checking. And when you have a few $1 million in the market, it starts to get scary because you watch CNBC and you see the red, the -3, and you go, oh, I'm in the market, because it's hard to understand that they're not really taking that kind of risk, right? His whole portfolio is probably a 4.5, right? Because he's a 4.5.
Yeah.
So we got invested like a 4.5.
Yeah. Which is pretty conservative.
Yeah. And that's okay. When the more folks get, the more conservative they get. Right? We got day traders I know that are like a 12.
Yeah.
Right? Because they haven't really accumulated anything yet. Wait till there's $3 million invested and they'll go, I
don't want to lose it.
No, they'll day trade options on like 50,000.
Yeah.
But the other portion, they want it in something more safe and secure. It's, there's a couple things that people want when they've saved well. They don't want to lose the money, and they don't want to lose the money.
Yeah. Yeah.